nifungie ile. So hello class, my name is Mr. Cosmas, and as usual, I'm your cost accounting teacher. So in the previous classes, we looked at various aspects of cost accounting. So in our today's class, we want to proceed and look at another area. So the area of our discussion today is on process costing. Now, process costing is just like we had seen, there are two things there. We have process and we have costing. So these are basically a model of costing where the cost units undergoes various processes before the final item or the final units of the commodity are obtained finally. Now, in this case, we may have, for example, if we are producing product like petrol, paraffin, and so forth, they undergo various processes. You can have process one. Once the process one is over, whatever the output of process one may go to process two, and whatever the output of process two, after we have done whatever is supposed to be done in process one is done, process two is done, it may go to process three. So we may have so many processes depending on the products that we are products that are being processed. Now, can have process three and then later finished goods. So in each of those processes, there are costs which are accumulated. So we accumulate, there are costs which are incurred. There are workers who are working there. We have materials that we are adding there. There are overhead costs that are incurred in each process. Whether it is process one, process two, process three, there are various costs that are incurred. And so in process costing intends basically to keep a record of the various costs that are incurred in each process. So we have an account for process one. So we talk about process one account to account for the costs that were incurred in process one. We may have process two accounts to account for the costs that were incurred in process two. And we may also have process three account to account for the costs that were incurred in that process. That's what we say process costing. So it happens where the units, the finished goods, before we get our finished goods, they passes through various processes. And as we have said, in each process, there are several costs that are incurred. So in this case, in this topic, it is about maintaining the costs that are incurred in each process. And the key thing here, you have understood that once whatever is supposed to be done in process one is complete, then the units are transferred in process two. Again, process two, there are workers who are there, they are paid, and therefore we are going to incur the labor costs. There are also other materials that are added there. After that is done, then go to process three. And so we can even be having process four, process five, or process five and six, and so on. So depending on the number of processes that we have, we shall then be maintaining account for each process in the manner that we are going to see. Now, in the course of doing the process costing, there are terms that we need to understand first. There are terms that we need to understand first, which are important for us. We have what we call normal loss. Normal loss. We have what we call abnormal loss. We have what we call abnormal gain. We have what we call a scrap, and we have what we call waste. So it is important for us to understand all these three terms, all these five terms. Now we start by understanding, now that we have understood what process costing is, because we have said process costing is all about us being accounting for the costs, the various costs that we are incurring for each process. And I've said for depending on how many processes we have, you can be having process one account to account for the costs incurred in process one, can be having process two account to account for the costs in process two, You can be having process 3 account for the costs which are incurred in process 3, and so on and so forth, depending on the number of processes that actually we shall be having. So in this regard, having understood that, we have what we call normal loss. Now, there are units which we are producing, there are products which we are producing. And so it may happen that whatever we had actually brought into that, process may not be exactly the same as what is going to be the output. For example, if we were to making tea and we had poured 3 liters of tea in the process 1, we are boiling that for purpose of making tea. We may end up that we may also, the output may only be 2 liters. It means that 1 liter is gone, 1 liter is lost. Now, depending on the nature of the operation of the organization and or the farm, usually the normal loss is that which cannot be avoided. It is expected on by virtue of the operation in place. So the normal loss, it is usually computed in advance, and the cost of normal loss is absorbed in the good production. So normal loss, by definition, is simply that lost units which are expected is the loss which is unavoidable. You cannot avoid it, unavoidable, and is expected to occur due to the nature of the production process. So that loss that we expect, you cannot avoid it. And usually it is basically determined on the basis of experience. That loss is what we refer to as normal loss. That loss is what we refer to as normal loss. So the loss that is avoidable, you cannot avoid it. And it happens from factors such as evaporation. So we cannot stop water from evaporating when we are boiling water. Some must be lost. So that which we are, that loss which we expect, and we cannot avoid it, we call it abnormal loss. So at times it happens that the actual output, whatever we are expected after taking into account the normal loss, is actually the actual loss is actually higher than that which we had expected. So if the actual loss is higher than the normal loss, then that extra or additional loss beyond the normal loss is what we refer to as abnormal loss. So abnormal loss is the extra loss, or is any loss. This is any loss above the actual, above the normal loss, or any loss above the normal loss. Normal loss is what we refer to as abnormal loss. So if we had the input were 200 units, for example, and we expect that we are going to lose 200 to 20, I mean. So we expect 80 units as output. But if we only get 170 units, then you can see initially the normal loss was 20, but here we are now lost 30. So the difference between the actual loss and the normal loss is that which we are referring to as the abnormal loss. So any loss above the normal loss is basically what we call abnormal loss. And we can also say that it is the difference. It is the difference between the actual loss, and the normal loss. So simply we are saying actual loss minus the normal loss. You are able to get the abnormal loss. So it means that the actual loss is higher than that which you had expected. The actual loss is higher than the normal. Then you talk about abnormal loss. Now, this also we have abnormal gain. So abnormal gain happens where the output that you had expected has increased. So in short, if you are expected more, you are expected a given normal loss, but you find that the loss has reduced. So then we talk about abnormal gain. So abnormal gain happens where the actual loss is less than the normal. So this is where It arises where the actual loss is less than the normal loss. So where the actual loss is less than the normal loss, then that difference is what we are referring to as abnormal gain. So we call it gain because you have been surprised. It is not what you had expected. You are expected to incur some losses above what you have actually incurred. So it means that actually you have gained in terms of your expectation. So we call it actual loss. We call it abnormal gain. So essentially, then we can say is the difference between normal loss and actual loss. Of course, when the actual loss is less than, so actual loss is less than the normal loss, then we talk about abnormal gain. We also have scrap. Now, usually, as a result of the production process, we are bound to end up with some other products or units which are of no, which basically they cannot be used for the initial intended purpose. So such values we call them such units we call them scrap units. So any units that arises out of any process that cannot be used for the initial intended purpose, we refer to it as scrap. They can only be sold at a very reduced value. So any units arising, any units or output arising from the production process which cannot be used for the initial intended purpose. They can only be sold at reduced price or value. Such is what we are referring to as scrap. So any unit or output arising from the production process which cannot be used for the initial intended purpose. Such is what we are referring to as scrap. Then also we have waste. When we talk about waste is any material arising from the production process that has no value. So any material or output arising from the production process that has no value. So waste, which means they can be sold for nothing. They have no value. Such is what we call a waste. Now we have those normal loss. So if you are told in an exam to define what normal loss is, you should be in a position to do so. The loss which is unavoidable and is expected to occur due to the nature of the production process. And then abnormal loss, any loss above the normal loss, it is the difference between the actual loss and the normal loss. So I've said where the actual loss is higher than what you had expected, then the difference is what you refer to as abnormal loss. Then also we talk about abnormal gain, and say this actual loss where the actual loss is less than the normal loss, then the difference is what you are referring to as abnormal gain. There's scrap value. We have said anything, any object, any units that arises from the production process, which cannot be used for the initial intended purpose, but can only be sold at a reduced value or price. That is what we refer to as the scrap. Then waste is any material or output arising from the production process that has no value. So those are those terms which are important for us to be able to determine. So remember to understand. Remember normal loss, or usually you will be given percentages of normal loss. They are usually based on the input units. So if it is 10%, and the input units are 100 units, then 10% of that becomes 10. It means that we expect the output to be 100, to be 90 units. So that's that. Now, having understood this, the next thing for us to be able to understand is how then do we maintain the process process account. So costing simply means we are costing, we are accumulating the costings, whatever we are incurring, basically for this particular for each of the processes that we may be having. So we may be having 2 processes, we may be having 3, 4, and so for each process you maintain an account to show how costs have been incurred in that particular process. Now, in this case, the process accounts is the account, usually you know the account takes the form of letter T that you may have known from your financial accounting. So the same also applies here. We also do double entry, which is very important, the debit side, and we also have the credit side. So on this case, we have the units, we have the cost per unit, and we have the amount. We have the amount or value. So we have that, we have that, we have that, and of course we have the description there. This side also we have the same. Of course we have the unit. They have the descriptions up there. Then we have the units. We have the cost per unit, and we have the amount. That's that. So every process costing must take that format. This side you can see units. How many units are you introducing? What is the cost per unit? And then you are able to multiply the amount. Because this will be in shillings. So up there you write the name of the process. So it is process 1. Process 1, you write the process 1. You say process 1 account. If it is process 2, you write process 2 account, and so on and so forth. So the beauty with process costing is that it is basically easy to master, just like we saw with contract costing, where on the debit side we are accumulating costs. So the same thing also happens here. On the debit side, we are accumulating the costs. So whatever the costs that are incurred in that process, we debit them. Whatever the costs that are incurred in each process, we are debiting those costs. Now, let's, for purpose of understanding, we wish to look at around 2 past paper questions. And at the end of the day, I think we shall be knowledgeable in terms of being able to tackle any question pertaining to process costing that we may come across. So we want to share a question, and the one we want to share, there are 2 questions there that we wish to share. So the first one is actually on first question is June, July 2023. So the exams that was just done the other day, there's a question on that, of course, by the Little Diploma students. That question, it is on question 3B. We are also going to look at November 2022. There was also another question on the same concept, and that was 7B. So we are going to share those 2 questions together for purposes of understanding what we have discussed clearly. So if you look at your screen there, you are able to see the first question. After we have discussed that first question, then we shall proceed to look at the second question. I want to believe that whatever I've explained in the process costing in brief, it has been understood. And so what remains is for us to be able to understand how then are we able to repair this cost accounting, this process costing account, if we are given a question on the same. So those are those. So I may, of course, we have been told Twanse. That's the first question that we are going to discuss. The first is in Twanse. So Twanse Limited produces a perfume that undergoes 2 processes to completion. So in this case, there are only 2 processes that this perfume undergoes. In each process, of course, there are costs which are incurred. And as I said, process costing is about accumulating the cost in each process. And we call that each process 1 account and process 2 account. So you saw the following information relates to the month of April 2023. So whatever information that you've been given there, they relate to the costs which were incurred for 1 month in respect of the production of this particular perfume. So the process 1, raw materials introduced were 50,000 kg, and the amount is indicated there. So if you look at that, what happens is that whatever will be the output there are the kgs, 50,000. And the total amount is 600,000. If you wish to get the cost per unit, then you simply divide the two, and you will be able to obtain your cost per unit. So you simply divide 600,000 by 50,000, and you are able to get your 12,000. So you have your 12,000 there. No, you get your 12, I mean, it's 12. So besides those costs, you've also been told that there is added materials, but in this case, none of those were added to my process 1. So it means that process 1, whatever the raw materials that we bought, no, there was no extra materials that were added in this process. So the other cost that is incurred here is direct labor. Direct labor. You can see you've started earning your mark. So we have direct labor, and the total cost in process 1 is 180,000. Remember there. So remember, when we are talking about process 1, we are only concerned with the costs that were purely incurred for purposes of that process. So in this case, it is process 1. Now, then we have direct expenses. Direct expenses, they are given there. So it is for this process 77,000. 77,000. Now, below there somewhere, because you have to see to it that all the costs that pertain to that process have been fully captured and included in the determination of what the cost basically of that process are. So in this particular case, you've been told the production overheads are solved on the basis of direct labor costs. So you can see the production overhead are absorbed on the basis of the direct labor cost. So if you look at the direct labor, for process 1, they were 1 to 80, and the process 2 is 20,000 shillings. And then we have overheads. So we have overheads. Overheads are actually indirect expenses. So in this case, what happens is that they are determined for their production overheads are absorbed on the basis of the direct labor cost. So essentially, you look at the portion of each month. So this month, this process, it is 180. The total is 180 plus the one which is incurred in process 2, that is 20,000, giving you 200,000 shillings. So the proportion of the overhead that should be absorbed by this particular process should be 180,000 times that total amount of overhead, which is 400,000. So this gives you this one, this is 2. So it is 360,000. So this process, the overhead will be 360,000. 360,000. Now you have done the accumulation of costs, then you've been told again, normal loss explained in process 1 and process 2 is 3% and 1% respectively. So normal loss, as I've said, it is usually based on the input in each process. So it is based that 3% on 50,000 kgs that were brought into process 1. So we have normal loss, you have there normal loss. It is 3%, so you determine the 3% of 50,000 so that you see what it is. So 3% times 50,000, that gives you 1,500. So it means we are expected to lose 1,500 units. 1,500 units. These are in kgs. These are in kilograms. Now, the next thing, then you've been told the output from process 1 and process 2 was 47,372 respectively. So in this case, you also balance. We shall be having, so we have the output there. So we have the output, and you see this goes to process 2. So we are transferring it to process 2, and we've been told it is 732. Now the balancing figure between this 1500 and the 732 and 50,000 should be able to give us what we call abnormal loss or normal loss. So if this side is higher than this, then essentially the difference is abnormal loss. But if this side is higher than this side, the difference is referring to as abnormal gain. So in this case, we had 50,000. That was what came into that process. We expected to lose 1,500. So that is 48,500. And you can see we expected, if that was the case, then we ought to have ended up with 48,500 as the output. But you can see we have ended up with a figure which is less than that which we had expected, which means we have lost more than what we had expected. And so that gives us what we call abnormal loss. So we shall be having abnormal loss there, abnormal loss. So abnormal loss or abnormal gain is just balancing figure between these two sides. So it's a balancing figure. That is what we call abnormal loss or abnormal gain. So in this case, it is minus 47,732. So it is the abnormal loss is 768, and then this side, this is that process. So it gives you 50,000. This is 50,000. Now we have to determine what we call the cost per unit for this particular output. So there is a third formula that I wish that I basically want you to master for getting the cost per unit. So the cost per unit for each process, it is simply the total cost minus the scrap value of normal loss. If you are able to sell normal loss for normal loss, if it is zero, there's no problem, over the expected production. Expected production. How much units? How many units did you expect to obtain? So expected production, where expected production is simply the input units minus the normal loss units. So in this case, the abnormal loss and the normal output will be costed on the same basis. So you can see in this formula we have left out the abnormal loss or abnormal gain. So the formula you strictly basically stick to the formula. Total cost, of course, the total process cost minus the scale value of normal loss, if any, which means if it is there. If it is not there, you ignore it, you put zero there. So now in this case, the total cost will be what we have here. So you add all the 600,000, plus 180,000 plus 77,000 plus 360,000. That gives you 1,217,000. 1,217,000. So we apply the formula. So here we shall be having 1,217,000 minus the normal loss scale value if they are there. So if you look at this question, let's see if it is there. So we've been told scrap units are sold at 3 shillings per unit. So we are able to sell this. So 3 shillings times 1,500. So it is 3 times 1,500. We are able to get 4,500. So it means whatever we have here, 4,500 as developed scrap over the expected. How much did you expect as number for the number of units? 50,000 minus 1,500. So 50,000 minus 1,500, that gives you 48,500. So 48,500. So that gives you 17,000 minus 4,500. So you get that to be divided by 48,500. So you get that to be 25. So the cost per unit here, as we have seen, this is 3, and so here you write 4,500. That's the normal loss. So it can even be 0. It does not matter. It depends with what the question is asking you, and each question is unique. Now you go to this other one. We are constant 25, so this is 25. This is also constant 25. So you are able to do the multiplication. 768 times 25. That gives you 19,200. Then also we have 47,732 times 25. That gives you 1,193,300. So if you add all these things, then all these three will come to this. And this is how the first process is prepared. So this is how we are able to prepare the first process. Then we've been told also to prepare process 2. So the way the question is styled, it is like each process basically has 6 marks. So this one was 6 marks. The other one was also 6 marks. So I'm wrapping this so that we go to the process 2. So the process 2, again, you do the same things. So we go to process 2. So process 2, same question. We have, so it was the input, the output of process 1 was 47. So you say process 1 because it is coming from process 1, and the units are 47,732. The cost per unit we got to be 25, and so this was 1,193,300. So this is how you have started now. You have you are now on process 2. We are done with process 1. So in the process 2, and you indicate up there so that we are clear on which process you are dealing with. So having got now having completed process 1, now we have transited to process 2. What happens is that we look at the cost again, which are going to be incurred in this process. And here you can see the added materials, or the material added materials, or material material that we are adding. We are going to add 2680. Then also we have direct labor. Direct labor here, only for process 2, it is 20,000. And then we have direct expenses. Only for this process, it is 266,100. So we also have overheads. So overheads, production overhead. And for production overheads, we had been directed on how to obtain it. We had said that for process 1, because it is based on direct labor, the labor that was incurred in process 1 for that month was 180,000 shillings. For this process 2, it was 20,000 shillings. So we are basically taking the proportion of the amount of labor that was incurred in process 1 over the total labor for process 1 and 2, which is incurred for that month. That we get the proportion, we apply it on the total overhead for us to be able to get the overhead for each process. So in process 2, we do the same thing. It is 20,000. That was what was incurred as labor over 200,000, which is the total, times the 360,000 times the 400,000. So this is supposed to give you 40,000. So the overhead here is 40,000. And then the process continues. When you say it is continuous, then you proceed and you are guided by the information. You've been told that as the first item that normal loss expected in process 1 and process 2 is 3% and 1% respectively. 3% applies in process 1 and 1% applies in process 2. So in this process, we have normal loss. We have normal loss. Again, it is based on input. And the input one, you just apply 1% of our input in that process was the output from process 1. So 1% of that, so 1 divided by 1% times 47,732, that gives you units. So it is the 47,732. So the scale value on this process again, scale values are so like that. So you've been told, regardless of the process, they are going for 3. So times 3. So times 3. That gives you around 140. Well, this is 14. So 1432. So that's that. Then again, you've been told the output in this process is 47,550. So the finished goods. So the output is to finished goods, because this process, this production only has 2 processes. So after the process 2, we transfer this to finished goods, and we've been told how much were transferred, 47,550. Then again, you do the balancing. So balancing here, we have that was 47,732 minus 47,550 minus 477.32. So it gives you a negative of, it gives you 295.32. So essentially, this tells you, and that side is high, this side is higher. So the difference is what gives you what you call abnormal gain. So this we have what you call abnormal gain. Abnormal gain, and abnormal gain is how much? It is 295.32. So if you add the 2, so this is not going to be 50 now, because this side is harder. So we add again. We have 477.32 plus 47,550. So that gives you 027.32. This is also 027.32. Now the computation is the same as what we had seen there. The total cost for this is the total cost you are supposed to, the total cost will be all that you add together. So it will be, so just do the additions. So we shall be adding all these costs that you have incurred here. So there we have 1193, 300 plus 2680 plus 20,000 plus 266, 100 plus 40,000. So the total cost so you add all this, that you have said, you add all this, and you're able to get this figure minus the scale value of normal loss, which is 1432, minus what we expect. Expectation was that if we add this as the input, we subtract that, how much are we getting? So it is 47,732 minus 477.32. So the expected production ought to have been 47,254.68. So let's see what that will give us. 15,22,080 minus 1432 divided by 47,254.68. That gives you 32. That gives you, so just a minute, again. We have said 15,22,080 minus 1432 divided by 47,254.68. So this is 32.18. So roughly, the per unit cost here will be 32.18. This is also 32.18. So if you are to multiply, then eventually the balancing figure should be the same. So this is 295.32 times 32.18. That gives you 9,503. 503. So it's 9,503.34. I know 503.4. Now the other one, this side, 47,550 times 32.18. we proceed. So basically, from where we are left, we are actually confirming the computations of this. So we have 47 by 50 times 32.18. That gives you 15, 30, 159. Now, if now you add all these things, you're supposed, this side automatically supposed to be balancing with that, and the difference may be due to those decimal places. So if you have the total cost now, on also the total amount, the total figures on each side should be 47,254.68 plus 9503.4. So this the total this would be 56,758.01. So it is roughly total amount is 56,75.8. So 56,758. 56. No, just a minute. I think there's something we have left out. So we left something out there. Just a minute. So we left something out. So it should be 15, 22, 080 plus 95, 03.4. So this is supposed to be 1,531,583.4. 1,531,583.4. Now that is how the process is prepared. That is how the process is prepared. So the other one was process 1. This other one is actually process 2. Now, if you are to prepare, because you can see you can be you have the abnormal gain here. If you are to prepare the abnormal gain, then because you can be asked to prepare the abnormal gain or the abnormal loss. If you are to prepare the abnormal loss account, then it is also set to it away. You maintain it. Like, for example, here you have abnormal gain account. So we have the debit, we have the credit. So we have the units there. We have the units. We have the cost per unit. And we have the amount there. We have the units. We have the cost per unit. We have the amount. Now, in this case, what you do is the double entry. This is debited. You can see this is actually on the debit side of the process 2 account. Now you simply bring it, it's debit there, so you credit that and say you write this process 2 account. Process 2 account. And you just lift the figures the way they are, 295.32. 295.32. The cost per unit is 32.18. 32.98. And the total amount is 9503. 9503.4. But because you are going to sell this amount, this much, it is going to be reduced by the much that the scrap value. So we shall be having the scrap. You can have the cash or the debtors. You can say talk about scrap debtors, scrap debtors or the bank, depending on what we are receiving. So we shall be having 295.32 times 3. So whatever we have here, they are going to be reduced if that by the match of the scrap value. So 295.32 times 3. That gives you 8 885.96. So the difference is what you're supposed to take to the P&L account. So the difference goes to what you call P&L or income statement. So income statement. So income statement will be 950. You have 3 there. 0.4 minus 885.95. So the difference becomes 95. So just a minute. This is 9503.4 minus 885.95. So the difference is 8617.45. So this is how that is prepared. So if we are to prepare a whole gain account, it is prepared in that manner. 9503.4. So you can see what is happening. It's just a double entry. The first figure was debited here, is credited exactly the way it is. And because of the scrap value aspect, the 3 shillings there, we are going to reduce the much of this profit by that much. So what we are getting, what we shall be told the income statement is 8617.45. If you are to prepare abnormal gain account will be appearing this side as you had seen the process 1. So if it's abnormal gain account, then you also open the abnormal gain account the way you have seen here. But instead of crediting here, you'll be debiting the amount here because of the double entry. Credited, debited. And then you transfer this scrap value to this other side, and the balancing figure also will be able to transfer the income statement. But for the abnormal loss, the value for to be taken to the income statement will appear on the credit side. That is the end of the process costing as a topic. So at your own free time, there are 2 papers that have been shared there. You'll be able to go through the second paper and see whether you are able, based on the concept that you have learned here, whether you are able to go through it. We have captured so many things. We have understood what process costing is all about. And we have said this is applicable where the units must undergo several processes. And each process, there are costs which are incurred. And so those costs are accumulated in each process, depending on the costs that are incurred. And we have said that for each process, we maintain a separate account. So each account, we purely accumulate only costs that pertains to that process. So the output of one process becomes the input of the next process, depending on the number of processes that we have, until the last process where eventually the output of it becomes basically the output of it are transferred to the finished goods. And we have also seen how we are able to determine the cost per unit when it comes to the finished goods or the what is to be transferred to the next process. We said it's basically the total cost for that process minus the scrap value of normal loss, if any, to divide by the expected units. So the expected units of production, we have said, is simply the input units for that process. We subtract from the normal loss from that process, and that will be able to get what is expected, and you are able to get the cost per unit as we have seen there. So that's the end of our discussion for today. Until we meet next, I wish you a good day on the same area. Thank you. Kasungu.
Imetosha.